Nvidia just reported and they are down 10% after hours. Here's what happened. This is their actual press release from their website. Quarterly revenue of $8.29 billion, up 46% from 1 year ago. Guys, I want you to remember this because if you're new to our channel, I preach about this all the time. How is revenue up 46% and the stock is down 10% after hours? It's all about expectations. So here's where they fell short. The market was expecting $1.29 per share in EPS. They reported 64 cents. However, that was including a 52 cent charge, after-tax charge for their ARM acquisition, which is $1.16. So they still missed by 13 cents, even adding that back in there. So this is what I talk about when I say, don't worry about the noise that's short-term. Look at the outlook. Because look at this, 46% revenue jump. That is huge. Other things in the company that I like that I'm seeing. This is their GAAP summary. Revenue up 46%, like I said. Gross margin up 1.4%. This means they were able to make 1.4% extra on every dollar they generated in revenue after their direct costs of goods sold. That's a big jump, guys. That's not something to be looking at. Now, here's something else, though. Operating expenses up 113%. That's what made their operating income and their net income and their EPS down. That's the big thing here, guys. They spent a lot of money on those operating expenses. So what do you do with that information? If you're interested in Nvidia, go do some more research on these operating expenses. If you're part of our community and you're in the chat, go in the chat and start talking to people about these results. Do some research together. Figure out, are these operating expenses long-term? Were they short-term because of inflation? I have no idea. But that's really, really important to understand the future of Nvidia. Is this a trend that's going to continue, or is it a temporary thing? Just like these earnings. The earnings had a 52 cent charge or whatever because of the acquisition termination or something like that. Okay, that's fine. That's a one-time charge. We're fine with that. Some other things, I always focus on the GAAP earnings, but right here are their expectations and outlook. Revenue expected to be $8.1 billion, plus or minus 2%, and that's including they have $500 million related to Russia and COVID lockdowns in China. All right. GAAP and non-GAAP margins expected between 65 and 67. And up here, they were at 65%. 65.5. Pardon me. So these are the things that their outlook is looking stronger. Their EPS missed. Okay. What else do they have here? Expenses. This is interesting. GAAP expenses of $2.46 billion. Guys, GAAP is what really matters. I focus on cash flow. GAAP is just generally accepted accounting principles. It's common for the industry. That's fine. That's why I like to look at cash flow. So let's go to our software. Just look at NVIDIA for the future. Okay, let's see here. Let's go. And again, if you're part of our community and you have the software, please log in, follow along. It's a great way to learn while you're doing it. Let's see here. Okay, well, look at this fall. 52-week high for NVIDIA is 346. 52-week low is 154.6. And after hours right now, oh boy. All right, so it's rebounded a little bit because when I started to record this thing, it was down 10%. Now it's down 8.64. So some key metrics here. Guys, 5-year PE, 88.25. 1-year PE, 43. And that's after falling by over 50%. Think about that, guys. So if you go look at our past videos of NVIDIA, yes, the chip market was huge, but it was driven up by the lack of supply. So everybody said, oh my God, lack of supply. They didn't care about the metrics involved. Yes, lack of supply is going to drive up. That's probably why they had a 1.4% increase in their gross margin. Lack of supply, you have upward pressure on prices. They can command more money. Fine by me. Dividend yield. Look at this dividend. Why do they even pay a dividend? What is this? It's the $400 million of their last 12 months, $8 billion, and the average of the last 5 years of $4.6 billion. Let's just go right to our 8 pillars tab. And if you're familiar with the 8 pillars tab, you know what it is. If you're not familiar, come on, get with it. This is great. So, 2 big X's, obviously, right here. They're 2 metrics of valuation. 5-year PE, 88. 5-year price to free cash flow, 91.75. Guys, that is high. That is high. Now, they are diluting us a little bit. They've issued 12.6% extra shares since 5 years ago. So they're diluting owners. Now, do I blame them? No. Why? The stock was expensive. Go get that the stock out there. Let people buy your stock as a way to fund your business. If your stock's expensive, give it to them. But you as an investor should know that's diluting you. I guess it's better than having debt, but you don't want them diluting the heck out of you like crazy. Prime example is Tesla. So here's the deal. Here's what this means. If you're diluted extra 12.6%, that means if their earnings and profit were up 12.6% that same period, you got no gain whatsoever because you're still sharing it with 12.6% more owners. All right. Now, obviously, lower debt levels, only 2.9 times debt of their free cash flow, with free cash flow increasing substantially. You saw the last 12 months had over double the last 5-year average. Cash flow growth, big. Revenue growth, big. Look at this, by the way. Revenue growth of $17.2 billion, and of that, 5.22 was increased cash flow. That's pretty solid, guys. That's 33% margin when they're, and look at this. It's very consistent. Their 5-year profit margin was 31.7. Okay, that's making a lot of sense here. So then we have to decide, okay, what do we pay for a company like Nvidia? It's fallen a lot. Has it fallen enough? So remember, if you're part of our community, stock analyzer tool. This allows you to put your assumptions in for the future. Nvidia is a great company. They have great products, but please, you need to separate the company from the stock price. You can love a company. I just got a Tesla yesterday. Guess what? I'm not touching Tesla stock, right? I own, my laptop at home has an AMD chip in it. I don't own AMD stock. My laptop here has Intel chip in it. I own Intel stock. I separate the company from the product. So, from the stock. Let's go to stock analyzer tool. Now, in this situation, I'm going to do a 10-year analysis and I'm going to make my assumptions here. Now, with this company, my goal is to be conservative with every company I do. So you're going to see these growth numbers and you're going to see my numbers and go, Paul, what the heck? They're so low. Guess what? Things can't grow 20% a year forever. This company did $27 billion in the last year in sales. So I'm going to sit here. I'm going to go 6, 9, and 12% for the next 10 years. And if you think those are too low, guys, go look at some of your favorite companies that were huge in the 2000s and how they did in the next 10 years. Growth is going to, even the best of best companies are going to do about 20% growth over a 10-year period. And that's the best of the best on average. So keep that in mind. Margin. Now, I do like this. Look at this growth. Look at this profit margin increasing. Of the last 10 years, it was 27.7. Over the last 5 years, it was 31.7. Last year was 36. So I'm going to be 28, 30, and 32. Free cash flow margin. I'm going to do actually the exact same thing. Now, PE. Guys, I'm still going to keep the PE higher than normal at 14, 16, and 18. And the reason being is it's a large company. Yes, does it have potential? Absolutely. And the more potential it has, you should increase this PE. But I still want to be conservative. So I'm going to sit there, and my job as a value investor is to buy when it's an obvious deal. If you told me to sign a 20 PE for it, I'd be like, well, in a bad market, they're not going to sign a 20 PE. So I want to be conservative about it. I'm going to wait till the numbers come to me, not me go to the numbers. I'm going to wait for the numbers to come to me. You always hear that in sports. Have the game come to you. Have the game. I'm going to wait for the numbers to come to me. And I always put a 12.5% return for my margin of safety because I can always get 9 or 10% in an ETF. So for my margin of safety and for my effort for doing the work, I do 12.5%. Lately, I've been hearing in our community that people have been doing 15% for more margin of safety. More power to them. Hit the analyze button. Now remember, the stock is currently at 154.94. So guys, look at this. Low end, 45 bucks, high end 91, middle range 64. And guess what? With a 40 PE to drop from call it 170 here to 60 is about, that would make it about a 15 PE. Okay, that makes sense. I would add this to my watch list to sit there and notify me when it hits there. But as of right now, guys, Nvidia, great company, great products, not the right price.